Right. So we're going to look at the contract cost, incidental contract cost. It's something very similar to the idea is similar that you find in IA 16, right? When you have an incidental cost that get added to the asset. So this is something very similar. So we're going to look at the cost of obtaining a contract. Sometimes you may suffer cost in order to get the contract signed, a contract performance obligations. Related costs, right? That means that in order to perform your contract, you may have to suffer some extra incidental costs. These incidental costs, right, should be treated as an asset. Right? We will be treating them as an asset, and if the company expected to recover them, basically, and the costs that we suffer to fulfill a contract, right, will be treated as an asset, provided these three conditions are satisfied. What happens is this: initially, when we suffer the cost, right, we would treat them as an asset. And then, while we complete the performance obligations, the pattern of transferring the goods or services to perform performance obligations, based on that, the asset that we've recognized would be amortized, right? We will be amortizing them, and of course, if there is an impairment also will be charged. That's this area. So what are the conditions that need to be satisfied, right? First, yes, you have a cost, but that cost can be directly related to a contract. You can identify the contract that the cost is directly related to, right? So the cost should be directly related to the contract, and then that cost that you suffered should enhance your performance obligations, right, in the contract. And then the third, that cost the cost that you suffered are expected to be recovered. So if these three conditions are satisfied regarding the cost, right, if these three conditions are satisfied, and also there are no other standards within which this cost would fall, right? There are no other standards within which this particular cost would come under, right, within that scope, right? So if it doesn't fall in any other standards, for example, as I pointed out, IA 16 would be a good example of property, plant, equipment, and inventories, and then the IA 30 is intangible assets. If none of the other standards where this cost would fall under, and in that case, the cost that we have suffered would be treated as an asset, right? So let me go back again. Here, what we are trying to look at is the incidental cost that we suffer sometimes, for example, fees that in order to get the contract get going, or maybe a postal expenses that we suffer during the contract. Right? Any other incidental cost means that directly related to the contract. So generally, when you suffer an incidental cost, we are supposed to treat them as an asset in our books, right? And then thereafter, we would be amortizing them, right? So the conditions are such: you should ensure that the cost can be directly related to a contract. You can identify that cost to a contract directly related. And then the second, that cost that you suffer should enhance the quality of the performance that you're going to deliver. And then the third condition is such that the money that you spent, the cost that you suffered, are expected to be recovered. Once these conditions are satisfied, and also there are no other standards that are within which this cost would fall under, then that cost can be treated as an asset, right? So once that cost is treated as an asset, then we would have to consider the amortizations and of course the impairment, right? Once we have recognized the cost as an asset, right? Once we have recognized the cost as an asset, then we are supposed to carry out an amortization, right? So the way that the amortization is carried out, we would use a systematic basis, right? We would use a systematic basis. It is consistent with the pattern of the transfer of the goods and services to which the asset relates to. So, for example, we have treated a cost as an asset, and then based on the transfer of goods, based on the pattern of the performance obligations, we would amortize the cost that we have recognized. That's what they're trying to say. On the other hand, for those costs, the next point is that suppose if you find out the amortization period of that asset, right? The amortization period, we suffered a cost obtaining a contract, and that amortization period, right, is less than, estimated to be less than 1 year, then it is no point of treating that cost as an asset, rather than you can expense them straight away to the profit and loss account, right? That's the other point that we're going to look at. Now let's focus on the impairment losses. Right, impairment losses, we know generally when you carry an impairment, we would the carrying amount, right, we would find the difference between the carrying amount, right, versus the here the first one, the impairment means the difference between the carrying amount of the um, right, the carrying amount of the asset that you have recognized, right, versus the expected considerations, you know, the remaining considerations. You may be expecting some considerations regarding this contract, right? The remaining consideration, right, that is you're expected to receive with regarding the transfer of the goods and services, minus less any unrecognized expense, right? Any unrecognized direct contract expense, any unrecognized direct contract expense. Basically, anything, you know, if it is lower than this, this is how we would determine whether the asset that we have recognized uh, will impair or not, right? This is what we try to find. So basically, in order for us to find the impairment loss, and then if there is an impairment loss, we would be recognize them in profit and loss account, right? So the way that the impairment loss is carried out, to the extent that the carrying amount, right, if this carrying amount is higher, for example, if this carrying amount was 150, but the money considerations, the remaining amount of considerations that the entity expect to receive, right? So we know we have transferred goods and services. The remaining considerations, for example, say we only expecting 80, right? And then less any expenses that we still not expenses that we suffered, direct cost that we suffered, but still we did not recognize them as an expense. Say that that was 10, right? So the remaining amount would be how much? 70, right? I change this to 15 so that we will get a different number. This is 15, so we will have 65, right? So the impairment loss for us here, the impairment loss would be equal to, the impairment loss here for us would be equal to 150 minus 65, right? That would be the impairment loss. Would charge the profit and loss account. This would be the impairment loss, right? So it's not a the big area for us to worry about much. So, but this is a contract cost. So when you suffer a cost that is incidental to the contract, that cost need to be treated as an asset first, right? And then we are expected to amortize them based on the pattern of the transfer of goods, based on the pattern of performance obligations. But on the other hand, yes, but there are 3 conditions to satisfy. First, to ensure that the cost can be treated as an asset. But then the next point would be amortization. And if the period is less than 1 year, the amortization period is less than 1 year, sorry, it is better that we would, it is more, we are expected to treat that asset as an expense rather than an asset, because the amortization period is less than 1. And the next, the impairment cost, carrying amount versus the expected considerations less any unrecognized direct contract cost, right? That's okay. So let's and then the next slide that I would cover on the presentations, right? I would cover this on the presentations. Once it is done, then we will do the next. Thank you.